So ladies and gentlemen, as I said, we now have with us Mr. Prashant Khemka, the capital management, and he's going to deliver his keynote address on how to steer portfolio towards continued wealth creation through the path crowded with high valuation. This is going to be a half an hour session, Mr. Khemka. Let's welcome him, Mr. Prakash Khemka, ladies and gentlemen.
Thank you, Aishwarya, for the kind introduction. And thank you all the participants for joining today. And thank you to the team at PMS AIF for giving us the opportunity to connect with the investors. The topic is very topical, if you will. There's a lot of concern among investors about valuations and how to steer the portfolio as the topic suggests. So I would divide the discussion today or my talk today in two parts, main parts, splitting maybe the title of the session. One is the session or the title presumes that the valuations are high. So I wanted to talk a little bit about that. And second is how do you manage the portfolio or steer the portfolio regardless of whether the valuations are high or not. So let me start in that order. First, on the valuations of the market. And this is obviously the perspective of the team at White Oak, and it could be somewhat different than what the perspective might be of the general consensus. What we believe at all times is that markets are fairly valued. We do not try to call the market as cheap or expensive. Market as a whole, we believe, is fairly valued. And we believe even if it is not fairly valued, it is impossible to say whether it is overvalued or undervalued. So to call the market, because effectively when people market ahead of themselves or overvalued, what they're trying to do is try to call the market, time the market at a better entry point. And in our view, that is impossible to do. Let's discuss this in somewhat greater detail. So it's our core belief is that the value of any company is present value of future cash flows, which I suppose most of the audience here on today's session, they either own businesses or run businesses and have to, as part of that, make investment decisions in projects or otherwise value other assets. And the value of any asset, any project is present value of future cash flow, and it's no different for any company that you invest in. And as a consequence, the value of the market at any given point in time is the present value of future cash flows of all its constituent companies. So if you look at Sensex or Nifty or BSE 500, the value of that is reflection of the present value of future cash flows. So that present value or the market value then is a function of two key elements: the cash flows going forward and the discount rates used to present value them. That is the ultimate reality. Any other thumb rule, P multiple, or high point, low point, or any kind of other thumb rule that you might use, they are all that they are thumb rules. The ultimate reality is that the value of companies and hence the market is present value of future cash flow, and the two key elements are cash flows in future into perpetuity and the discount rates used to present value them. Now these cash flows and the discount rates are, in today's day and age where capital is fungible and increasingly globalized world that we live in, they're correlated around the world. So the cash flows of Indian companies are correlated to cash flows of companies globally to varying extent. Maybe in IT services, they're more correlated. In other sectors, there may be somewhat less correlated, but they're correlated nonetheless. Similarly, discount rates are correlated across the world. The ultimate benchmark for discount rates is the US long bond rate, 10-year, 30-year, you pick, somewhere in that long-term range. US equity market multiple is a function of the US long bond rates. And the multiples of markets around the world is a function of or is correlated to the S&P 500 of the US, because they in turn are a function of the US long bond rate, or the discount rates in India are also a function of the discount rates in the US market, or the US long bond rate. So now in this context, if we were to think of valuation, so people say the reason people say valuations are high, because to them the valuations, the multiples, the PE multiples appear higher or at the higher end of the range that has been observed over the last 10, 20, 30 years, right? But let me give you the example of when I first went to the US in mid 90s. The interest rates back then were 6 to 7%. 10-year bond was 6%, 30-year bond was 7%. Today they are 1.5%, right? So the bond multiple in the 90s was, if you invert the 6 to 7%, that will be 14 to 17 multiple. Call it 15 multiple was the bond multiple. And the market multiple S&P 500 that time was also 15 to 17 multiple. Now today the bond multiple has gone from 15 to 17 times to 100 times, because interest rates have fallen to about 1%, right? So inverse of 1%, the multiple on bonds have gone to 100 times. Whereas people still expect equity market multiples to be the same, which is unreasonable. Equity market in US have gone from 15 times odd to 20 to 22 times. I'm not suggesting the markets ought to go to 100 times, but I'm putting it in context. If the discount rate has gone from 6 to 7% to 1%, you cannot expect multiples to be the same or similar as what they were when the interest rates were a lot higher. Let me go a little bit deeper into this. As you know, going back to the present value of future cash flows, which can be written as cash flow divided by R minus G. So the bottom, the denominator is R minus G. R is the discount rate, which is typically for equity markets used, computed as risk-free rate plus the equity risk premium. So in 95, if the risk-free rate was taken as 6%, and equity risk premium was taken as 5%, then the discount rate was 11%. If growth, which is, let's say for a company like GE, which was representative of the economy, was taken to be in line with the nominal GDP rate of US, that would be 4%, 2% real rate plus 2% inflation or GDP deflator, so 4% nominal GDP growth. So the cash flow multiple for GE would be 1 divided by 11 minus 4%, which is 1 divided by 7, which would have been 14 multiple or thereabouts. Today, if you were to do valuation on the same first principles basis, which is very sound, logical underpinning, then the risk-free rate has gone to 1%. Let's assume for a minute equity risk premium is the same at 5%. There is very logical rationale to believe equity risk premium also would come down in line with a risk-free rate, but assume it to be 5%. Then 1 plus 5 would be 6% as the discount rate. The nominal GDP growth rate, the real rate is still remains 2%. If inflation has gone down, let's say inflation expectation, GDP deflator has gone down to 0.5%, then still you have in the denominator 6 minus 2.5, which is 3.5%. So 1 divided by 3.5% is closer to 30 times compared to, for the same company or similar company like GE, what was 1 divided by 7%, which is 14 multiple, today would be 28 to 30 times cash flow multiple, which would then imply, depending on cash flow conversion, an earnings multiple of somewhere in the range of 20 odd times. So that is, something that is very logical in our view, why the multiples worldwide have gone higher, because interest rates over the last 20 years, and it's not just last 20 years, over the last 40 years, interest rates have gone down from what in 80s, early 80s, the US long-term interest rates were in double digits, in fact, in the low teens, because inflation had spiked up to double digits over there. And for the last 40 years, inflation expectations have been going down in the US because of the spike in inflation in the late 70s, early 80s, and quite sticky inflation for several years. inflation expectations, which means long-term expectations about inflation, got reset higher in the late 70s and 80s, and they took quite a long while to come down, and they continue to come down. And today, as we sit, inflation expectations are more or less dead around the world. In lot of, and that is the reason why interest rates are zero to negative in a lot of the developed world. The biggest worry in the 80s and 90s decade for central banks and central bankers and governments around the world was controlling inflation and inflation expectations. Today, majority of them are worried about deflation and how to increase inflation expectations. Some of the countries like Japan have tried several tricks to increase inflation expectations. So that being the case, if inflation expectations are down to zero or thereabouts, interest rates cannot be mid single digits or higher. They have to be closer to zero as well. And in that context, multiples for companies, assuming the cash flows are not that negatively impacted, the combination of cash flows and interest rates would work out such that the multiples are going to be higher. So, what's the risk? The risk would be if there is a reset of inflation expectations that is higher. Now, we don't know whether that's going to happen, and it would be very naive and simplistic to assume that that is going to happen. We may be in for next 50 years, 100 years of very low inflation expectations, and maybe there's a spike in inflation expectations. I'm just saying that there is no rational basis as of today to assume that inflation expectations would be reset higher. And again, I'm emphasizing inflation expectations rather than inflation, because inflation can move higher in a year or two without materially changing long-term inflation expectations. Now, why has inflation and inflation expectations come down over the last 40 years? In our view, it is due to the rapid advances in technology. Uh, Pretty much the start of technology era can be traced back to early 80s with the advent of personal computer. And many of you might remember, in India, the computers really started popping up in laboratories and then in banks and all in the late 80s and early 90s and so on. So that was the start of the tech era. Then mobility, mobile communications, and internet came more or less simultaneously in the 90s. And the combination of the three, personal computing, mobility, and internet, is now culminating into the smartphone, which all of us carry all the time, which has tremendously increased productivity and enabled rapid advances in applications of technology, which are all very deflationary. So to give you a specific example, inflation, the two key pillars of inflation and inflation expectations are commodity inflation and wage inflation. In commodity inflation, the primary source of inflationary pressure has always tended to be the biggest component has been fossil fuels, crude oil, and also coal and others. Till 70s, 80s, and all, and even till now, there's a strong cartel, OPEC cartel, but it was a lot stronger till I would say a decade ago than it is today. What has broken the power of the cartel is a couple of things tied to the rapid advancements in technology. One is the discovery, and I shouldn't say the discovery, but the exploration of shale oil in the US. Shale oil wasn't just discovered now a decade ago. Everyone knew shale oil existed, and that existed that's been there for millions of years, right? What was made possible due to technology advancements was the commercial viability of shale oil. And so shale oil could be brought out of the ground such that US now has become an alternative Saudi Arabia of sorts. And that's too, and that too, it's not cartelized. It is in the hands of hundreds, if not thousands, of private capitalists, oil explorers who are seeking to maximize their profit, and they cannot, just the sheer number cannot form a cartel. Leave aside the fact that cartelization would be illegal in the US. So that the rapidly declining cost of exploring and bringing out and developing the shale oil fields has put a permanent lid on crude oil prices. Simultaneously, what has happened is the entire evolution of technology on the solar energy and battery powered vehicle, electric vehicle front. So you're completely bypassing fossil fuels. You're tapping solar energy, which was a sci-fi concept till 20 years ago, or commercially not viable, and you're transforming that into battery power to fuel vehicles, which again was a laboratory experiment till a couple of decades ago. Nobody would have thought this would be possible as soon as it has become possible. So that chain of solar power fueling the batteries, which is then powering the cars all around, is completely bypassing fossil fuels, coal as well as crude oil. So the price expectations for these fossil fuels have been permanently capped, and that has resulted in one of those two pillars, which is the based inflation expectations to be dead going forward. And secondly, wage inflation. Again, technology, with all that, if there is any merit to the valuations of all these Nasdaq listed companies, which I'm sure most of the people on the call today have either found a way to invest in or want to find a way to invest in because they believe in all these Nasdaq companies. If there is any merit to their success, they are also all deflationary and wage deflationary in nature. If you believe in drone delivery, and even in India, surveys of land have started to be done by a drone, right? And drone delivery in the US is very much, beyond the concept stage, and rapidly getting deployed. Autonomous driving, machine learning, robotics, artificial intelligence, all these are wage deflationary. So both the pillars, and that's one of the reasons pre-pandemic, despite record low unemployment in the US, wage pressures were de minimis compared to historical standards. So we are only 4 decades into the technology era, and it is accelerating at an exponential pace. Imagine where technology was 40 years ago in the 80s, early 80s. Imagine where it developed to in the early 90s, the huge progress made by early 90s, and then the early 2000s, the massive progress made by early 2000s, and now the teens, 2000 teens, and the 20s. Each decade there are leaps, technology advancing by the leaps, and this is very deflationary, and this can stay there for many decades to come. And in such case, inflation expectations may remain subdued for a long period of time, and multiples may remain elevated or even move higher over time. That's not our base case. That is a what I'm talking about is a fundamental explanation for why multiples might be justifiably higher and may remain higher or even move higher over the coming many years and decades. So we are certainly not in the camp that says that these are artificially inflated multiples because of all the liquidity that is being pumped in by central bankers and so on. To us, that is a very convenient face-saving rationale for macro gurus and macro experts who've been wrong for the last dozen years. They've been talking about this theory for the last more than 12 years since Lehman Brothers crisis, because these have been doomsayers who need some face-saving excuse on why the markets have been on a tear over the last 12, 13 years, and the economies and the markets have done so well. So they blame it on central bankers. In our view, there's a more fundamental reason, which is what I walked you through, which is the demise of inflation expectations, which then naturally, fundamentally, and logically would result in lower interest rates and hence higher multiples. So that's on the valuation. I want to speak the next 5 to 7 minutes now on how we approach in our portfolio. Having already said that we take for granted that the markets are fairly valued, what we focus on, and just to give the framework here, to generate consistent, strong performance, in my view, it's crucial prerequisite to have a focused investment culture, what we call performance first culture, meaning that we must generate the highest return for our clients compared to anyone else in the peer group. It is founded on these four pillars of philosophy, team, process, and portfolio construction, which are aligned with one another, meaning that it's a stock selection based philosophy of investing in businesses rather than betting on macro. To go with it, we have the best team in the industry of stock pickers, implementing a time-tested process that's been developed by myself for over more than 25 years, and all along maintaining a balanced portfolio, which is very crucial aspect of risk management, and which consciously avoids macro bets and ensures performance is a function of stock picking, because macro bets only introduce risk without generating any return. So I'm only going to spend a couple of minutes each on the philosophy and the balanced portfolio aspect in the interest of time. The philosophy of the team is that outsized returns are earned over time by investing in great businesses at attractive valuations. So the two key elements are great business and attractive valuation. We are looking for the most powerful combination of great business and attractive valuation. These valuations are all relative. There's no such thing as absolute value. As I discussed already, all valuations are correlated. Valuation of every company is only makes sense relative to the valuation of the market. So we are looking for relatively attractively valued businesses that are also great businesses. What makes a business great is one that has these attributes of superior returns on incremental capital, scalable, and well managed, both in terms of execution and governance. These are born out of the fundamental first principle based equation, which is that value of any business is present value of future cash flows. So to generate cash flows in future sustainably, it's prerequisite that return on incremental capital is superior to cost of capital. It's a prerequisite. Otherwise, there'll be no cash flow generation. Scalability is about sustainable growth rate, or the G. Uh, can the business multiply itself relative to the peer group in the industry or corporate world in average is what we're trying to assess. And then when you have the potential for these two, it's crucial also to have management that has strong execution DNA to deliver on it. Otherwise, despite many banks starting at the same time in the mid 90s, some like HDFC Bank and Kotak Bank have created lakhs of crores of value, whereas others had to be bailed out or went bankrupt, right? So execution DNA is very crucial to assess. And first and foremost, the governance DNA, which is the starting point for the team. If and only when there is adequate governance, does it make sense to do more work? Otherwise, for companies with poor governance, the best way to make money is to stay out of them, at which our team has done an extraordinary job. When you find companies that possess these attributes, and such companies are there at all times, whether the markets are high or low, overvalued or undervalued, depending on what your belief is. Such companies are always there, and many of them are always, even if the market is overvalued, relative to the market, companies would be undervalued, right? Some would be overvalued even compared to the market, and some would be undervalued. Our job is to create a portfolio of companies with these great fundamentals at attractive value. And when it comes to valuation, we don't look at PE multiples or EBITDA multiples at all. These are distorted, misleading, and hence harmful if used. What we focus on is cash flow based DCF approach, as well as cash flow based multiples, what we call OPCO FINCO multiples, or multiple of excess ROIC, which is on next slide, which I don't intend to go, but every company go through, but if every company is split into two entities, FINCO and OPCO, where OPCO represents the value of excess ROIC and FINCO represents the value of invested capital. And we view the value of the company as the sum total of invested capital plus value of excess ROIC. This is the framework that we use for analyzing and valuing companies. Now coming to, so this is the stock selection approach. Every company that we select must, our endeavor is that must outperform the market over a cycle. Now, if we go to slide 15, it talks about the portfolio construction approach, which is where I'd like to spend 2-3 minutes. So the aim of risk management is to ensure that performance is a function of skill rather than luck. And skill resides in stock picking. Macro is all luck. It is like coin flipping, trying to time the market, trying to do top down bets on sector. That's like coin flipping. You can do a PhD in coin flipping and yet be no better than the layman. It's like, when just like in cricket, you can't expect the best captain, be it Kohli or Ajankya Rane or Dhoni, you can't expect them to win the toss. India lost most of the tosses in Australia. Unfortunately, Australia batted first. They scored a massive total, and India had to bat on the last day. But what Indian players had in their control was how well they can play. They in India played like Pant as well as Pujara, and we won the series. What India did not have, even the best captain didn't know, was how to win the toss. And the same is true for investing. Even the best fund manager or investor does not know where the market is headed. If they believe they know, then they don't even know what they don't know, in our view. So we think of any factor risk like market timing as you can think of it as the dotted line on the right hand side graph. It goes up and down. Only in hindsight you know where you are. Our aim is from stock picking perspective to only own stocks that fall substantially above the x-axis. We make some mistakes as well, but let's say we do more right than wrong, and we generate the double-edged arrow as the outperformance. Within the portfolio, we'll have pro-cyclical companies as well as counter-cyclical companies. So pro-cyclicals are like financials, real estate, industrials, and so on. Counter-cyclicals are like staples, pharma, and so on. At all times, our endeavor is to have a good balance between the two, because if we can have the good balance, so, just like in a team, you have a pace bowler, spinner, aggressive batsman, defensive batsman, you have a good balance in the portfolio. If you have good balance and good team of companies, then not only can you deliver outperformance over the cycle, but you can also deliver outperformance consistently during all sub-segments of the cycle. And then you don't have to worry whether it's a year like pandemic last year, you don't have to worry where the market is headed, and you can focus all your time and energy on the game, which is the stock picking. And hence, in a year like last year where the team delivered top notch, I believe by some statistics I've seen, top ranking performance, and more, equally important is top ranking performance last year for a team was fact that in the first quarter when markets nosedived, the team had massive outperformance. And over the next 9 months when the markets rallied dramatically, the team again had very sizable outperformance. And as a whole also, the team had very sizable outperformance. So magnitude of outperformance was a function of the team's stock selection capability, and the consistency of outperformance is a function of this balanced portfolio construction approach. So I hope that was useful. We touched upon the valuation aspect, and we touched upon our stock selection philosophy as well as portfolio construction / risk management approach. I packed them all in half an hour. So hopefully you could keep pace with us. Thank you so much, everyone, for taking the time. And I hope you enjoy what is an outstanding lineup that PMS AIF has arranged over the next 2 days. Over to you, Aishwarya.
Thank you very much, Mr. Prashant Khemka. That was truly, truly enlightening. What an insightful session and very remarkable keynote, I have to say. With that, ladies and gentlemen, we're now moving to a panel discussion, in fact. And what we're going to do here is that we're going to actually gauge the current volatility in the markets, and we'll observe, analyze, learn, and then apply knowledge. Because the session that's coming up is what do you make out from the behavior of markets in 2020, and how does one apply Buffettology in the new post-COVID world of equities? Our speakers for this session are going to be Mr. Ramdev Agrawal, Mr. Sameer Arora, and this will be moderated by Mr. Neeraj Shah. I'm going to be introducing our speakers and our moderator in just a bit, but let's get them online. So just give us about 2 minutes and we'll get this started. Look up and look forward for this panel discussion.